Think back to what you were thinking and feeling in early March 2009. Remember that in addition to all the turmoil in the financial sector, with the collapse of Lehman and massive government bailouts to rescue banking and industrial giants alike, home values were unraveling, people were losing their jobs, and supposedly diversified portfolios had seen dramatic drops in value. Indeed, between mid-October 2007 and early March 2009, the S&P 500 lost 57% of its value. But it felt worse than that, because along the way it might rise a bit, raising hopes, then travel sideways, and then abruptly plunge again. So at that point in early March 2009, what were your expectations about what the markets would do next? And based on those expectations, what were you thinking about how to position your portfolio, both for the near term and, in order to lessen the damage from any such crisis like that again, for the long term? Were you seeing it as a screaming opportunity to buy? At the other extreme, were you seeing it as the imminent collapse of the world financial system? Were you despairing and paralyzed? Or were you concerned but confident in the long-term power of the markets to recover? And as the subsequent years unfolded, how, if at all, did your thinking shift? Did you stick with your investment method? Or did you begin approaching the investment process differently? If so, how? Today, in part 2 of our 2-part episode on the roots of our own investment philosophies, your co-hosts outline the story from where we left off in episode 1, sharing how our expectations evolved in the wake of that financial crisis and how we approach investing today. We discuss the refinements and modifications we've made to the dominant portfolio allocation method today known as modern portfolio theory. We outline some of the hedging approaches we've adopted, including the strategy of raising cash, shorting strategies, and trend-following strategies. We discuss our shift toward the use of so-called factor-based investing and explain some of the most prominent factors, including momentum, value, quality, size, and volatility. And we outline 2 ways of measuring whether a market overall is generally priced cheaply, fairly, or expensively. Listen in for all that and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here as always with Erik Olson and Adrian Nicholson. Adrian, you had started our conversation with some interesting news today. Why don't you start us off?
Yeah, of course, Roshan. Right now, there's a lot of turbulence in the cryptocurrency market. Have either of you two seen that this morning?
Yeah, we're recording on Wednesday morning, the 19th, for our listeners, and I definitely woke up to a lot of negative crypto news with it crashing today. Saw stuff online, and a friend of mine texted me, "Crypto bloodbath" is what he wrote.
I've been seeing that stuff too, and I first started getting a little bit worried about it. I think it was like a week or 2 weeks ago, when SNL released a skit, and they were talking about Dogecoin, Doggycoin, whatever you want to call it, and just kind of making jokes and puns about it. So once I kind of saw that, I'm like, oh man, this doesn't really bode well for the future once SNL gets a hold of it. So that was my first kind of warning signal, and today you're kind of seeing it play out right now.
Yeah, and I was listening to another podcast that is not investing related at all, and they were talking about how the hosts bought some of the Dogecoin before Elon was on SNL, thinking that would drive it up, but it actually did the opposite. And he was complaining because in one sketch, the punchline of the joke, they finally got Elon to say it's a hustle.
Yeah. Mm-hmm.
And so he was like, why would you say it's a hustle and cost me all this money?
Oh, man. So they tried to get ahead of the curve when they heard Elon was going to come on and talk about it. That's oh, man.
Yeah, they've just did it in reverse, right? They thought it would go up because of him, and I think people thought that before and sold before. So they were just a little late to the party, is what it sounded like. Although um, it's not something I follow very much. Dogecoin, aside from all the media, or the I guess it would be the news stories about the people that are talking about it via social media. So that's what I've seen more of anything. And as we say that, I was just curious. It is down 28% this morning right now. So that's been a roller coaster, right? I think it started the year at I'm looking it up right now at 0.02 cents. So, or this is 1 year, not year to date, but either way, it was at 0.002%, went up 2 cents, went up to 74 cents, and right now it's trading at 34 cents. So it's a wild ride with that one.
Erik, what's kind of your take on all this that's going on?
Oh, I think we should actually do another episode on crypto, honestly. I think my thinking continues to evolve about it, but in terms of today's news alone, I'm not surprised, or honestly, I don't think it necessarily changes the thesis.
Yeah, well, and it's funny that you mentioned we're talking about this, because I've heard Adrian, you had said being on SNL. I've definitely heard recently comedians do like a whole set on crypto. So and what's interesting about crypto in general is the pro crypto people are going to take that as we made it because the mainstream world and SNL are talking about us, and the people that are anti-crypto are going to say, well, that's when it's peaked, when everyone knows about it.
Yeah.
So same data point, different responses.
Yeah, exactly. And I actually have a friend that's probably gonna hit me up today about it, where a couple weeks back we were talking about this podcast, and he's like, man, you got to do a podcast for people that are new to investing or just getting into investing, and have it focus on compound reinvestment interest and not focusing all your research on these new and upcoming cryptocurrencies. He was just very adamant about it. And I was like, all right, I'll see what I can do. But he was just like, yeah, there's just so much going on in this investing world with the cryptocurrency and the markets and everything. I want to hear some good news out there, some real solid fundamentals, not all this new stuff that's trending, coming out on social media constantly, that's just being thrown in my face. And I was like, all right, I'll do my best, but I appreciate the feedback.
You got to point him to some of our season 2 episodes on the really building the foundation of your financial plan.
Yeah, those were a good ones,
because we touched on that. Then Adrian, you've got to cross promote some of these episodes.
Exactly. We're coming up almost on episode 100 too, so I'm excited about that.
Yeah, I actually did that recently. I had a buddy ask me who probably started listening 2 months ago, but he said, have you guys ever done an episode on the difference between mutual funds and ETFs? So I went through our descriptions, found the episode, and sent him the link. But as you said, Adrian, we've done 100. So my initial response was, I think we did, but we may have just talked about it and not done it. Let me look into it.
We're almost at 100. I think total episodes posted, we're in the 80s right now, but we have to do something big for episode 100.
Yeah, getting close. Erik, you got to record from some mountain trail or something, or from backpacking trip or something like
fantastic.
That for 100.
Yeah, that would be awesome.
So, gentlemen, I'm going to jump us into our topic for today. We are continuing what we started last week, which was the evolution of our investment methodology, our investment approach. And we talked last time about modern portfolio theory, what we liked, what we didn't like, how we still use it now. And we're going to build on that with what else it is that we do. I think this is a very important topic because, as I mentioned the last episode, and I'm sure I'll say it again today, there are many ways for people to invest profitably, and you've got to figure out what method of investing fits your personality type and makes you most comfortable. And then you take a deep dive in that to make sure you understand it well, and then that methodology can work for you. We're sharing our journey to find what worked well for us and what we like to do, and we're going to continue on to what we like to do. And if we don't touch on it enough, I'd love to talk about things that we either tried and didn't work, or worked but we just decided wasn't right for us. So Erik, I'm going to pass it on to you to start out, and just bringing us back to last week. After you completed your journey of using modern portfolio theory and deciding that you needed something in addition to that, where did you go next?
So we pick up the story then at the bottoming of the great credit crisis, I'll call it, from October of 2007 to March of 2009. And if you listened last week, you heard me explain that my initial expectation, as we got that very powerful bounce off the bottom after March 9th, was that we were really just setting ourselves up for what's known as a bear market rally, or sometimes as a dead cat bounce, and that after it would come back, some of the hyper selling that occurred in September, October, November, December, and then again another leg down in January and February, I was expecting that we would still have more to do. And what I saw, which we all learned, is that we had, yes, some minor bumps along the way in 2010, 11, and 12, but for the most part, that rally was real and constant, and with certainly some very abrupt downturns, and most especially and memorably were in late or January of 2016, and then late 2018, and then of course with the coronavirus concerns in February and March of 2020. For the most part, that has been an unmitigated success coming off of that bottom. But my initial reaction on all of that was to start to turn, because I wasn't convinced of that. I started turning to some hedging strategies. And those were essentially augmenting the modern portfolio theory approach with essentially shorting strategies for part of the portfolio. As well, I threw in some commodities and more real estate and things that were outside the usual formula of stocks and bonds. In 2012 and 2013, my process took another step, but I'll save that. Let's just pause right there. So between 2009 and 2012, that was my thinking: hedging, wider diversification, as modifications to, but not a rejection of, modern portfolio theory. How about you?
So in 2009, when things had bottomed, I would say my personality tends to lean more towards the value investing side, and which is looking for undervalued stocks. So I, at that point, was not in the same position as you, or I didn't have the same thought as you of the markets are going to have another leg down. At that time, I thought things looked undervalued. So I had the modern portfolio theory strategies in place, but at that point, what I added was a modification where I looked at valuations and the business cycle. And so I was actually bullish at that time, so I was fully invested, but the modifications I added at that point to modern portfolio theory were that we would look at overall market valuations and the business cycle to determine which way the portfolio will lean. And how I explain this to clients is, if we reviewed your risk tolerance, and let's say you were a moderate investor, well, when things looked overvalued and things looked look like they weren't the opportunity wasn't as great in the market, we would slightly lean you a little bit towards moderately conservative, and when there would look like there was an opportunity, we would slightly lean towards moderately aggressive. So I had this discussion to make sure they were comfortable with it. So my modification at the time was to take valuations and weight the portfolio, whereas contrasted slightly to yours, where actually I would actually say what we did was a little bit different because you were hedging at the time, but I would argue that we were both hedging, just using different methodologies. Our data points were different, right? But I was saying when I thought things weren't looking good, I would overweight bonds and cash a little bit, and when I thought things were looking good, we would overweight stocks versus the bonds and cash.
So in terms of the pursuit of favorable valuations, were you expressing that through a tilt toward asset classes that were on the value side, or were you expressing that through individual security selection that you thought had really attractive valuations?
A little bit of both. So there were definitely individual securities in there. So looking at individual stocks, but also looking at exchange traded funds, and within the modern portfolio theory framework, weighting a little bit more on the stock portion of the allocation.
Oh, so more towards stocks at that point because of valuations.
In 09. Because of valuation. And I definitely didn't catch the bottom by any means. Like I didn't time it right. So when I say 09, I'm speaking generally to the first half of the year. I couldn't tell you if we made that shift. I could look it up and look up exactly when that shift happened, but at this moment I couldn't tell you if we made that shift in January or June. It's just that I went from modern portfolio theory and using the pure efficient frontier model, and then I started adding modifications to it, and the modifications I added were, one, looking at market valuations and using the market valuations to add a little bit more to stocks or a little bit less to stocks, and going to the other side, either bonds or cash. And then also, in addition to valuations, looking at where I thought the business cycle was. Now, what's interesting, Eric, and I may be fast forwarding past a step, so feel free to take us back. Well, those data points I was using for market valuation in 2013 started showing that the markets were overvalued. And for those of you that don't remember, if you look back, the markets have almost tripled from 2013 to 2021, right? So the modification that you made about hedging in 09, I started looking into and adding a little bit in 2013, and that's when I started getting conservative. So it sounds like the impact of the 2007 to 2009 crash, the Great Recession, on you had you. I think it had us both acting or investing a little more conservatively at certain times. But for you, that was in 09, and for me, that was in 2013, because the data points I used to get me to overweight stocks in 09 were now saying things were overvalued. And I'm going to pause there and let you continue yours, because that evolved as well.
I just want to share a quick point first, Roshan, before Eric gets into it. But I do like both of the strategies you use. Yours, Eric, where you talked about putting some more hedging tactics in, looking at different asset classes like commodities, and I believe you said real estate. Real estate was another one. Yeah, I mean, those are all great ways to diversify and just combat all the different types of risks that there are in the market. Like there's business risk that's specific to certain companies, inflation risk that can be pretty much curbed by, commodities or real estate or whatever it may be. Just kind of diversifying yourself to kind of look at the different risk elements that could impact your portfolio and just reduce them a lot. I think that's also a great way to start. And Roshan, I like what you talked about, kind of looking at the value space. Could you kind of give a little bit more insight on our listeners, how you kind of went about it? Like you said, you looked at maybe individual stocks. Like I know looking at different valuations, looking at their balance sheets, seeing if they have a strong dividend or kind of some trends or some concepts you see where you look at value. What was kind of your process when you had let's just say you had two different strong value companies? How would you kind of go about it? If you could kind of give us a little bit more insight on that.
Yeah. So when you're looking for value stocks, and it's actually a great question to talk about the evolution that I'll touch on briefly. But when you're looking at value stocks, I was looking at the time at various ratios, everything from there's a well-known investor, Joel Greenblatt, who has the magic formula. He also used what he called earnings yield, which is like an inverse PE. I looked at low PE ratios. I looked at what a lot of famous value investors methodologies were. Warren Buffett, David Dreaman, Joel Greenblatt. I went to a course at Columbia University to study it further. So there isn't a single answer to what I was looking for with valuation, because it does look different from a company perspective. But one of the methods I really liked was Bruce Greenwald has a method that is based on Benjamin Graham, who's considered the grandfather or the father of value investing and even just securities analysis. He wrote Dodd and Graham literally wrote the book called Securities Analysis that greats like Buffett followed. But they have a method where you look at a company based on the value of the business as well as the value to recreate the business. So they're two different data points. And if you're 30% below both of those values, that's when you look at buying. So that was some of the valuation methods I used for individual stocks. For the market as a whole, though, I would look at various historical PE ratio factors like the cyclically adjusted PE. And then there was a method that Warren Buffett used called total market cap over GDP. And I'm sorry for throwing all this stuff at the listeners. Blame Adrian. He asked. But anyway, I saved those last two for the end because those two are the data points that started saying the markets were overvalued in 2013, which then led me to being a little bit more conservative, which I learned for a variety of reasons was actually not the right move. And I think this points out not only our last episode and this together, just the whole theme, but even what I'm specifically talking about now points out to our listeners that if you do this on your own or if you have an advisor, over time, these strategies will evolve, right? The advisor gets better over time as an investor. You get better over time as the investor. And no matter how much research you do to come up with these methodologies, as you continue and work through the market, you'll refine the process. So some of these changes we made to modern portfolio theory early on in our career are likely more significant than adjustments we made later on in our career, because we make minor tweaks after that with not only with what the market does, but the more that we learn along the way. So Adrian, great question. Yeah. I apologize if I downloaded too much data.
No, it's perfect. I mean, the more data, the better, but it really shows how important it is to adapt and don't be so stuck on a certain method that's been, working for you for some time, but then there could be just some macroeconomic event in the future that could kind of just stir that for a loop. So it's good to always just have that built-in flexibility.
Yeah, and one more point I'll just make real quick, and then Eric, I'm going to ask you about the next step in the evolution. But one of the advantages we have as advisors is that we are constantly bombarded with firms that are saying to us, we can do a great job managing your client's capital. And I've gotten to the point where, and I'm sure both of you are similar, where in seconds you can say, is this worth looking into or not? Right? We get so many of them. You get a quick email, a quick call, ask a couple questions, and in seconds you can say this is worth further research and evaluation or not. And when you get those few where you take a deep dive to learn whether their methodology is good for your clients, one, if it is, we can implement it with our clients. But two, if ultimately we decide, hey, this isn't as good as I thought, you learn something from that research and analysis that you can then use for your clients. That really enhances the what we can do and how we can learn in real time. So not only will your investment approach evolve because the markets change, but you'll learn along the way from a behavioral finance perspective what you do and don't like, and also from more a qualitative perspective, what methods things are working in other places that you can pull from. So Erik, now I'm going to pass it back on to you. In 2009, you started adding these hedging strategies. How long did you continue going down that path with the hedges in place as the market was appreciating?
Yeah. So probably until about 2012, at which point then I started to have another shift in my thinking. Number one, it was becoming increasingly clear that the Federal Reserve was committed to something it had never done before, which was to flood the system with capital. And as a result, the tide of Fed Reserve support, as well as to a certain extent the fiscal policies early on, at least in the Obama administration, were something that was very hard to factor based on previous experiences. So it did seem as though, given the old statement, it's different this time. So, but with that, I was doing a lot of reading, and it sounded like you were doing a lot of reading. So we were reading in different places. I was reading, as I mentioned, because of my background as a systematic trader, a quantitative, statistically oriented trader. I started looking back at the literature on systematic quantitative approaches to investment. And that led me into this world of factor investing. So you were talking about one of those factors, values, and you were speaking about it both at the individual security level, as well as at the asset class level, as well as at the entire market level. So when I'm using the term value, first of all, I want to acknowledge just the importance, I think, of having those big picture market-wide valuation measures in mind. You mentioned two. I want to explain those just briefly for our listeners because they were nuggets of gold there, Roshan, and you just went through them so quickly. So I'm going to just explain them in the simplest terms. The listeners, one of the two that Roshan mentioned is known as the cyclically adjusted price to earnings ratio. And that is as a modification of the well-known price to earnings ratio. In other words, how much do I pay in dollars to buy the company stock versus how many earnings per share are they generating? And if they're generating pennies, but it cost me if it's, let's say, it cost me $1 to buy their stock, but they are only earning a penny a share per year, then it tells you that the price to the earnings in that case is 100 to 1, $1 to 1 penny. You can say, or if instead they were generating, let's say 10 cents of earnings per year, then the price of $1 to the earnings of 10 cents would be 10 to 1. And that would be considered a much more attractive valuation, a much more worthy candidate for considering incorporating into your portfolio because it's just generating that much more profitability. Well, at the broad market level, when you look at that, not only you'd think that price to earnings would be a good measure across the entire market, but in fact, not only is price changing, but so are earnings. And so it becomes, in that sense, a little distorted. So the cyclically adjusted price to earnings ratio attempts to solve that movement of both the numerator and the denominator in that ratio by saying, let's instead take average earnings over the last 10 years and adjust those, in fact, even for inflation. So now we have a sense of what a company, or for that matter, a broad market, is generating in broad earnings on average. Now let's talk about the price compared to that much more stable denominator. And what Roshan was pointing out, that in 2013, we started to get at fairly pricey levels, and those levels honestly have just gone up and up and up. Another measure that's even simpler to explain is the Warren Buffett measure, which is how big a check would I have to write to buy every stock in the US stock market from every person who holds it, every institution that holds it. Right now, that number would be, I think, about $42 trillion. Then compare that number to the current size of the US GDP, which is currently about, I believe, $21 trillion. So as you have just heard me say, that ratio currently then is about 2-to-1 or 200%. We have not been at a 200% level, it is, to the best of my knowledge, at any point in the past. And whereas looking at, you mentioned, Roshan, your sense of, wow, things are really on attractively priced here in early 2009. At that point, the cost, the check that you have to write to buy every stock from every person who holds it for the entire US stock market was only about half the value of the US stock market. So what a discount time to buy relative to now. So with those as backdrops, in 2012, I started saying, okay, let's get back into this literature on various factors, value being certainly one among them, but not the only. And several other factors kept surfacing over and over in this literature. They go by different names, but I'm just going to use the most common name for each of them and give just a short explanation. So one is known as momentum. Momentum is really very a simple concept. Whatever has been moving up strongly, most strongly over the last, let's say, 6 to 12 months, has a better than even chance of moving up in the next 3 to 6 to 9 months more than those things that were falling the most in the last 6 to 12 months. In other words, let's use it. That's a hard concept to understand, probably on a case of a single stock, but let's just take the stock market as a whole. If we divide it into 3 parts, the third that has been rising the most over the last 6 to 12 months, the third that's been falling the most over the last 6 to 12 months. Take the top third and then ask the question another 6 to 9 months later, which of those two groups went up the most? What the interesting finding is that the stronger horses in that trailing 6 to 12 months continue to be, as a group at least, the stronger horses in the next 6 to 9 months. A very interesting finding that you can use to your advantage in this process. If nothing more, one way in which you might use that to your advantage is to avoid the idea of trying to catch a falling knife. Wait till if something's falling and you think, hey, this might be a great time to buy, it might be a great time to buy, but it also might be a terrible time to buy. So maybe just give it a little chance to cool off and settle down and not be in that worst third.
Yeah,
So
yeah, Eric,
value.
that's a good point. And there's
Mhm.
also some technical indicators too that I like to look at sometimes where, like you mentioned, there is momentum. I believe one indicator is like the moving average convergence and divergence. There's certain resistance or support levels where, like Eric said, you might see like if you look at like the past data on a stock and it kind of consolidated around a level and it broke above that level and now it's headed down. You might think that could be a new support area where you could catch it, but like Eric said, it could be a falling knife where it breaks below that support level and keeps going down, where you look at these different indicators to see what might be a good price, or it could be the opposite where it's kind of breaking up to a new high, but there's like a lot of overhead resistance. So you believe that it might not be able to break that price level, but it does. Just looking at these indicators are strategies that people could look into a little bit more. But I think that's some of the great points that you brought up, Eric. You can continue.
Sure.
Yeah, actually, I want to add one thing there too. Just explaining that term, catching a falling knife. Yeah, it's commonly used just by investors, and it might be obvious as it sounds, but when the price is dropping, that's not enough reason to buy, right? So Eric and Adrian both mentioned either momentum and technical indicators that are saying the price has bottomed. I think back with that term and thinking back to people, I remember back in 08, 09, a colleague of mine who's actually, he's since left the industry, but he was trying to tell me that we should buy Lehman and Bear Stearns stock after the fight. And this was in the fall.
Wow.
And his whole rationale was, and I can't remember the exact numbers, but I think it was a Bear that went down from like 50 to like $2 or $3. So yeah, it was 50 the other day. It was $2 or $3 afterwards. And Eric's reaction and Adrian's is because those companies went out of business. You know, Lehman went out, left completely, and then Bear was then with the Fed's help, bought by J.P. Morgan. But the point is, a stock isn't a good buy because it's cheaper today significantly than it was yesterday. Right? You've got to look at other factors. I talked about value and valuation. Erik was talking about factors such as including momentum. So I think thanks for clarifying a little bit of gold that I didn't expand on. I was just returning the favor there.
All right. Well, thank you. So the other factors that there's a cottage industry of finding factors, right? So if you mine the data, if you what is it? If you torture the data, it will confess. So there's probably 300 or more factors that people have found, but several of them over and over and over again have been found to be pretty durable in different environments, different markets, different asset classes, and so forth. Value is one, momentum is another. A slightly harder one to define is known as quality, but you can take that as essentially a commentary about the magnitude of their profitability and their cash flow and their earnings, and the growth of those. Another is volatility. So while on the one hand we know that if we compare different asset classes, the more volatile asset classes tend in the long run to generate longer or greater long-term returns. Stocks are more volatile than cash, and stocks accordingly generate in the long term more returns than cash does. But within an asset class, the surprising finding is that lower volatility strategies or lower volatility instruments, as a group, I'm not talking, there are certainly exceptions at the individual stock level, but as a group, lower volatility things have shown a surprising capacity to perform at least as strongly as the high volatility ones. So so momentum, value, quality, volatility, and then I can't forget to mention size, because in the long run, smaller company stocks have outperformed larger company stocks. That's not always true. And we've just come through a period where actually many of the things that I just said were completely undermined. Large companies, until the downturn from the coronavirus, large companies had been strongly outperforming small companies for about 3 years. And growth companies had been strongly outperforming value companies as a group for probably close to 15 years. So in somewhere in that neighborhood. So these factors are not necessarily bankable in every time period. But as I started to understand more about factors, then what I did is I started looking for ways of capturing those factors in our clients' portfolios. I started by looking for others that were doing it in a way that I thought made sense. I didn't find them, and so I built my own. I'll pause there. And so how about you? Where are you now in this story?
Well, so and what year is this?
2012,
when are you
2012, 13, 14, 15 in there.
So what's interesting is we're both looking at the same markets, looking at different data points. And because our data points are different, we had different reactions, right? What I was looking at told me 2009 was a good time. I went in and that worked out well. That was correct. And then those same factors were telling me that 2013, things weren't looking good and I needed to start getting more conservative.
Oh, well, I
right?
did too. I mean, I was looking at it with concern at that point, but my response to that, the concern, I guess you might say, that led to a more conservative approach was actually the motive for looking at factors, and one I didn't mention, which is trend following. So I'll come back to that, but say more.
Yeah. So in 2013, though, you're adding these factors in 13 through 15, and that is telling you that is, and tell me if I'm wrong, but that's telling you, hey, it's a good time to invest. Or are you getting more bullish at that time because you were conservative from 9 to 13?
It's a little bit more complex than that. So the nutshell version is that I said I'm going to have for I don't know that necessarily many of our listeners know this, but I run 3 strategies in addition, 3 stock and ETF strategies that I don't talk a lot about. But as a matter of fact, today is trading day for one of those strategies that is a quarterly strategy. So last night I went through 4,500 stocks, and I've now narrowed it down to the final 50 likely candidates for today's assessment. But in any case, what it was, Roshan, was to say, I'm going to adopt a timing overlay on ETFs. That was in 2012. And then I'm going to develop a timing overlay for individual stocks, and that was in 2013. So the timing component has a rule that says if markets break downward, or actually if the individual securities within this portfolio violate a certain measure that I use, then they are disqualified from remaining in the portfolio. And I judged that would be a way of safeguarding, in alignment with the conservatism that you had expressed you were feeling. In my case as well, markets are overvalued. I'm going to have a position or a method as part of this, a systematic method for avoiding massive capital losses if there is another big downturn. But I'm not going to waste the opportunity if I'm wrong. Like I proved to be, my thesis was wrong from 2009 to 2012. If I continue to be wrong, then I want to have the juice on my side, if you will. I want to have located the positions in my clients' portfolios on the side of the things that historically and empirically are superior. So it was timing to as a safeguard, but factors as a propellant.
Got it. So and that's what multi-factor investing is, right? When you use multiple things to help you make your
correct
decisions.
And these are all multi-factor models.
Yeah. So in going back then to 2013, you're adding that timing overlay. My evolution of modern portfolio theory, which had done really well for me from 2009 to 2013, now are flashing that things look overvalued. Yeah. I'm getting more conservative, and the markets are going up, right? So I'm real. And remember, these moves aren't huge, right? These shifts in risk tolerance. However, the shifts in risk tolerance are causing me to underperform what the strategy should be doing, right? I'm telling you, let's get more conservative and protect the portfolio. Right. Meanwhile, the S&P in 13 is up 30%.
Yeah, it was a banner year.
Over 30%. And then 14, it's up 13%. 15, it's up only a point, but then 16 and 17, it's up 11 and 21 until we have a down year in 18. So as this is happening in 2013, I'm watching this and I'm realizing that the data points I'd use, that though I've enhanced the modern portfolio theory, we're doing better than we would have or than we had been. It's having an extended period of underperformance. And I use this phrase with my clients all the time because it's the asterisk to any investment strategy, can have an extended period of underperformance. Right. And whenever I mention that, I always like to point to Buffett, the greatest investor of all time, because there are multiple times in his career where the press is saying he's too old and he's lost it. And then the markets go back to where value does well, and he is the greatest investor of all time again, and he's a genius.
Yes.
Again, right. So what the next thing that I then added at that point was doing multiple strategies, and here is where I was adding what would be similar to your multi-factor approach. It's a momentum-based approach, but it does use multiple factors in the strategy, similar to you, where you had looked towards others that have this data. You had to build your own. I was able to find an organization with an algorithm that had multiple years of outperformance in up and down markets. And I was able to adopt some of what they do, have it, customize it, and use that. But going back to your what you had said earlier, which I think is very important about how you run multiple strategies, I do the same to avoid those multiple periods of down markets. One is what we've spent a lot of time on our last episode talking about, which was the modern portfolio theory, though I've modified it with additional factors. In addition, we have a strategy that is also multi-factor, but I call it momentum because that is the majority of what we're looking for in that case is the momentum defined by factors that we have an algorithm for. Also, I'd mentioned earlier being a value investor, so looking at undervalued stock. And I've got two different strategies that are in there. One is an annual shift of buying undervalued stocks based on valuation at the time. Other is more opportunity driven, where we will look for opportunities in undervalued stock. We'll also use technical strategies. And finally, within these strategies, I'll also use options primarily for covered calls to generate income. So the reason I do that, and I mentioned so many strategies and with each of these a little bit of detail within them, is because I'm hoping to avoid that extended period of underperformance. And so in my personal investing world, I've seen a period where modern portfolio theory did well, and I've seen it break down for a long time. I've seen a period where value stocks have done well, and I've seen that break down, and then similar with momentum. So going back to what we do as financial planners, and as I say to my clients all the time, I use a lot of assumptions in your financial plan. One of them is based on the expected rate of return. The more consistency I can get with the expected rate of return, the better job I can do planning. And the majority of my clients are more concerned with living their life in retirement as opposed to the investment side. So having these multiple strategies helps me get that consistency.
Yeah.
And that then leads to a more reliable plan, which means that you can vacation in retirement and not worry about your finances.
Yeah, I like that, Roshan. You kind of answered my question, where it seems like just kind of the way you described it, the more strategies is better. Where if you have maybe one strategy, you have that kind of asterisk, like you said, you might have a year of underperformance. But isn't there also maybe like the opposite end, where maybe you have like too many strategies that could all be competing too much for like the same slice of the pie, where, if you kind of like, it seems like a lot of like annually looking at all the strategies. All right, this one has been underperforming. It's time to take it out because all these other strategies want to compete for that kind of share of it. I know it's kind of like the Goldilocks, like too few strategies, it's too cold. Too many strategies, it's too hot and takes away. It's kind of finding that like middle ground, like just a small group of strategies where you can like take away that extended period of underperformance that could affect your financial plan, your retirement, and your vacation dreams, so to speak.
Well,
yeah, so that's a good question, Eric.
Sure.
Let me give a brief answer, then I'll let you pick up. I have not seen a data point to tell me sort of how many strategies can lead to sort of missed opportunities, but I build them based on the amount of clients investing, making sure we have something in each, because I don't know what will outperform. But Adrian, you mentioned annually. I view it as these strategies are competing for my client's capital. And I actually will monthly look at the different strategies as to how they're doing. And if I see trends as to one doing better than the other, then I'll wait a little, increase the weighting to one and decrease it slightly to the other if I'm seeing a consistent trend with that. So I'm sure there is something where you're spreading it too thin. I don't feel like that's the case now, because in particular, coming off a year like 2020, when the markets, had dropped, almost 40% in a month, having those strategies and those different factors to protect the portfolio were very helpful.
Yeah, I guess to the question is it possible to have too many strategies? I would say I suppose at a theoretical level, yes. And I will just mention as sort of as reference, since Roshan, you've mentioned them in the past, Ray Dalio and Bridgewater Associates. So groups like that, these giant, what I'll call commodity trading advisors or hedge funds, at least those that are using a systematic process. In many cases, what they're doing is they're using literally hundreds, if not thousands, of different systems. Because in their case, we have talked a lot about diversification. We're thinking about that, or at least we have been using the language of diversification primarily with respect to assets, large cap stock, small cap international, et cetera, as examples of that. They're using diversification not only in different assets and different categories, different commodities, different stocks and categories as well, but they're talking about strategy diversification. So recognizing that each of those is going to have periods of thriving and each of those is going to have periods of kind of cooling off and underperforming, they can level their returns by using multiple strategies, literally, as I said, hundreds of strategies simultaneously. And then they monitor them. And when they see that one isn't performing well, they'll turn it down or turn it off, monitor how it would be doing. And then when they see that it's starting to come back into play, they turn it back on and reincorporate it into the overall asset mix. So I think it's, as you pointed out, Roshan, it's just knowing when something is and is not working. But I also want to say for clients who might be saying, what, this is too confusing. I would say that part of my strategy or my approach, let me restate that, my approach to recommending a portfolio for a client has a lot to do with what I perceive to be initially that client's starting point for understanding markets and also intellectually as well as emotionally able to accept divergences in performance when a strategy isn't in favor. So, for example, some of these strategies I talked about, which were related to size, since small caps until the downturn, the bottoming of the coronavirus downturn in March of 2020, small caps had been suffering for quite a while, but now, particularly on small value and mid-size value, they've been killing it coming out of that. For those strategies that were dependent or at least tilted toward the small size and toward the value side, they underperformed during that period. Some clients can only take that for so long before they start going, why are we doing this? So for some clients who are less patient even than that, who are, I'm going to tell a story here in just a second, but to define what I mean by less patient than that. But if for those clients that are less patient than that, I think it's important, even though it may not be the optimal way to manage their assets in the long run, from a purely objective standpoint, it may be the most rational way to manage their assets in the short term until they have developed a sense of familiarity with the investing process and have developed more knowledge about the investing, and through that process, both of the gain in knowledge and the gain of emotional resilience with markets, then and only then, I think, does it make sense to say, hey, let's from my perspective, you may disagree with this, but then and only then does it make sense to say, let's widen the lens here and start incorporating into the portfolio some things that I think will help you in the long run, though you should understand we don't know if they will tomorrow or even in the first quarter. I've got a couple stories about that, but let me pause there and see how you react to that.
Well, I completely agree with you on there. That's another part with investing in general. There is your risk tolerance, and that you've got to think about from a numerical perspective, but you've also got to think about behavioral finance, and that's exactly what you're addressing. So, Adrian, going back to your question of how many strategies are too many or factors, as I mentioned, we'll use based on the client and the portfolio will vary some of these, and certain strategies I have that clients have more than enough asset level, but their comfort level from a risk or volatility perspective, or even sometimes I definitely have clients that don't want to own any individual stocks because they're just not comfortable with that. They only want funds, right? And I have clients that are on the other side of it. So some of these strategies will use for everyone, where they'll have a little bit in each, and other ones will have people in just one because for whatever reason they're not comfortable with any of the others.
Yeah. So I had a conversation last week with a client who's watching one of the positions in her portfolio that over the last decade has compounded capital at a rate of about 19% per year, well in excess of many of the other diversified options out there. But it hasn't had a great quarter. And in fact, from the beginning of the year until now, this particular asset class is down about 20%. But this is common for this particular asset class. It regularly goes down by 20, and then it goes up by 50 to 80, and then it goes down by 30, and then it goes up by 50, and then it goes down by 25. It's just that cycle over and over. But within all of that, nevertheless, the gains dramatically outperform. So when this client was asking me, well, it was down 2% yesterday when the markets were up a 0.5%. And I said, you're right. It was actually, in that case, there was about a 3% divergence from that day. But you have to take all the days when it's had a divergence from the market, some up, some down. And on balance, its divergence is positive. And especially on a daily basis, on balance, its divergence is positive. And more than that, on a quarterly basis, its divergence is positive. And over a 5 and 10 year period, its divergence is dramatically positive. So it isn't on the basis of one day, 1 week, 1 quarter, a good basis for deciding that, well, this is a terrible thing to have in my portfolio, or this is a terrible strategy. No, it just hasn't worked in this moment, in this very brief evaluation period, as you were expecting that it had based on its long-term return. But this is still normal behavior for this particular security, and from my view, should remain in your portfolio. You're the boss, but and my job isn't to dictate, it's only to advise. But I'm advising you to let this work for you over the long haul and not focus on the daily divergences.
Yeah, and that's another thing that I think is dangerous. But you've also got to look at the individual client, because I've worked with. We recently are working with someone new who had all of her investments in her 401k, and she didn't know the login and password for it, so she never looked at it. She got quarterly statements. That was kind of it. And she just started working with us a couple. I don't even think it's been 2 months, but I spoke to her yesterday, and she at length, and she was wondering about the markets going up and down all the time. And that was the first conversation I had was, well, how often are you logging in to look, and what were you doing before with the 401k, which is how I found out about it. So has got to either learn to get more comfortable with the volatility, and this market is highly volatile, right? So it's not necessarily all on her, but get more comfortable with the volatility, or log in less frequently than she did before, right? So whatever it takes to make her comfortable, or lower the risk in the portfolio. She's not that risk either, or lower the risk so that she's more comfortable with the daily volatility. But something needs to be changed, because though the risk is the same as it was before, and all that's changed is her frequency of monitoring, and this market is highly volatile, something doesn't line up. So we're going to work with her to figure that out. But you bring up a very, very good point there as well with your example, and I think mine is similar. It's just not one holding, it's just overall your comfort level. It's another reason we have multiple strategies. And as I said at the very beginning of us recording this, is there are multiple ways you can have an investment portfolio and have good performance. You've got to figure out what works for you and what makes you comfortable.
So
Right. And Erik, you and I'm sorry to just say one last point. You and I talked a lot about factor investing and how we weren't comfortable with modern portfolio theory. And we felt like there needed to be adjustments out there. Well, there are a lot of people that use modern portfolio theory still, and they're totally comfortable with it. Right. And we would argue with them as to why ours is better. I'm sure they would argue as to why they think theirs are better. If we agreed with them, we'd keep doing it. So we obviously don't. But my point, it just goes back to my point of, not only you as an individual investor can find multiple ways that you're comfortable with that'll work for you, advisors who do this on an everyday basis find strategies that are comfortable for them.
Yeah. Well, listen, there's so much more that we could say. And I would think I'll just summarize the sort of like the final principles for me, and then you can maybe summarize the final principles for you, and then we can extend this discussion into another episode, I think, as well. Because one thing we haven't discussed at all is the use of alternative investments in my portfolio. I know, or my clients' portfolios. I know you're less convinced that necessarily is additive, but I would say, generally speaking, in terms of the approach philosophically that I think you and I both possess, it is systematic rather than discretionary, or what I'd say more quantitative than qualitative. I would say more thinking about it more than from the standpoint of I would say more active, although not discretionary active, but quantitatively, systematically driven active, as opposed to passive. And I think those are the philosophical principles that guide my thinking today. It's, let's be empirical. Let's see what historically works the most, or the most and the best over the longest periods of time, and let's put those things in your portfolio to your advantage.
Yeah, and with my approach, it's similar in that I'm looking for things that have a history of good performance in both up and down markets, and I'm looking for things that have where the selection of the holdings, the thought process is different, because to me that leads to the consistency. So though, Erik, I have one of my strategies we've talked about before that I think is very similar to one of yours. Our modern portfolio theory approaches are slightly different, right? I've got modifications and use it in its purest sense. And then I've got a individual stock strategy that's slightly different than yours. So we've got multiple things we'll look at, but in the end, I'm looking for strategies that outperform and do well in both up and down markets that will lead to that consistency, and then we will adjust the weighting to each strategy based on how it's doing currently. So, gentlemen, I think we went at length with this, and Erik, we can definitely talk about alternatives. I will add that to our list of show ideas. To all of our listeners, if you want us to expand on what we're talking about today, or if you have other show ideas, please reach out to us. Let us know. We would love to accommodate you. As we've mentioned, the tax efficient investing definitely comes from conversation from clients, as does our option episode. So we are listening, and we definitely want to discuss whatever topics you'd like to hear. Please tell your friends about us, like and subscribe. This has been another episode of the Retirement Lifestyle Show. We'll be back next week as we quickly approach 100 episodes.